right, welcome back. Bruce Porter joins us now for this week's Dollars and Cents segment. Thanks for coming in. Good to see you. All right, we're on a roll with this whole series about retirement. We're almost finished with our 10-step discussion on planning retirement income, and we're going to take a look at today's topic, which is number 8, taxes in retirement on Social Security income. Is this complicated?
Yeah. You know what, Albert Einstein, the hardest thing in the world to understand is the income tax.
I would agree with that.
And he said that like 100 years ago.
Yeah.
But it's still that way.
It's still the case.
Right?
Yeah.
I mean, taxes are hard to figure out. So you figure we're retired, we're on Social Security, and we all know that Social Security income is tax-free, right?
Right.
Unless you make too much money. And then they're going to dip back in. So a portion of your benefits might be taxed depending on what they call a combined income or provisional income. All right. Now, what is that? So you take your adjusted gross income, which that includes all taxable income, right? Then you got to add in non-taxable income. So a good example of that would be a lot of seniors buy municipal bonds because they're tax friendly.
Okay.
Right? So municipal bonds are exempt from federal tax, but the income from the municipal bonds are used in the determination of whether you have tax on your Social Security or not.
So they do add into the total amount, the formula, if you will. Okay.
Right.
Okay.
So you got your adjusted gross income, you got non-taxable interest earnings, and you got half of your Social Security. So if you're making $24,000 a year in Social Security, half of that would be $12,000. So if you've got $10,000 for the municipal bond income, there's 10, and then you've got all other income. So let's say you got another $12,000 of other income.
Other income.
All right. So what is that? That's 10, 20, 34,000. All right. If you're an individual, 50% of your Social Security will be subject to taxation. If you're married, filing joint, then above 32,000, 50% would be subject to tax. So the thresholds are for an individual between 25 and 34,000 of provisional income determines 50% taxation. If you're above 34,000, 85% is subject to tax. Now, if you're married filing jointly, then the thresholds are a little bit different. It's 32 to 44 for 50%. Anybody above 44,000, so if you've got a big pension, you know, and you've got investment income and you've got all this income, 85% of your Social Security is subject to taxation. Now, it doesn't mean it will be taxed. Depends on deductions and things like that. That's for you and your accountant to work out.
To figure out,
right? But it is subject to the tax calculation, and you got to understand that in retirement because, again, we are voluntarily unemployed. We're living on a fixed income. So if we can manage more effectively to reduce our tax liabilities, that just puts more money in our pocket. So let's talk about how the 1%ers do it.
Don't I wish I knew?
All right, well, I'm going to give you some tips.
Okay.
All right. Think about the benefits of Roth IRA.
Yes.
Now think about the benefits of the income from the Roth IRA. It is tax-free. So if you've got Roth IRA income, there's no tax on that, and it does not count as part of the calculation for Social Security.
So it doesn't add into that formula.
That's right.
That's what you're saying. Okay.
Neither does cash value life insurance policies that you're drawing monthly income
like
from.
an annuity sort of thing?
No, life insurance.
Just life insurance.
So if you've put into a whole life or even a universal life plan all these years and you've built up a large amount of cash value, these 1%ers know that trick. They've put thousands of dollars in large life insurance policies, and now at retirement, they are borrowing against the death benefit through monthly income, tax-free. So you're borrowing against the policy, it's tax-free income. Okay?
I've always heard it said that that's how wealthy people get wealthy. But
now, another 1%er idea. If you've got taxable cash creating 1099 income that you're not using for income, put it in a non-qualified deferred annuity, and you eliminate the 1099 income, and you still get the benefits of the accumulation and the future value that later in life for long-term care, or if your needs change, you can always tap that income later on in life.
So
but between now and then, you defer it and compound it.
So there are things that you could do, but boy, it takes somebody like you to help figure that out.